Number 1. Believing dividend stocks don't grow. If I asked you to name companies that grew massively over the last 30 years, you'd probably say Microsoft, Apple, or Johnson & Johnson. Now here's what most people forget. These companies didn't just grow in stock price. They've also paid and raised dividends consistently. Dividends in 2012 and has grown them steadily. Johnson & Johnson, they've raised dividends for more than 60 years in a row. That's not boring. That's generational wealth creation. Mistake number 2. Thinking dividends are a waste because you could just sell shares. This is a popular argument, especially in modern investing circles. People say, why bother with dividends when you can just sell stock when you need cash? But here's the issue. Selling means reducing ownership. Dividends give you cash without touching your core shares. That creates a safety net. If the market crashes and your portfolio is down 30%, selling shares locks in those losses. Dividends, however, keep flowing whether the market is up, down, or sideways. That steady income helps you stay invested while everyone else panics. Now, mistake number 3. Chasing the highest yield. This is one of the fastest ways beginners get burned. They see a stock yielding 8%, 10%, even 12%, and they think they've found a gold mine. But high yields often signal danger. A company under financial stress might raise yields just to attract investors, only to slash payouts later. That's called a dividend trap. The smarter play is focusing on companies with moderate yields, say 2% to 4%, that consistently raise dividends every year. Over time, that's where the real magic happens. Let's talk about dividend growth, because this is where most investors miss out. Imagine buying a stock today with a 3% yield. That doesn't sound exciting, right? But if that company grows its dividend by 7% per year, in 10 years you're effectively earning 6% on your original investment. In 20 years, that's 12%. That's how ordinary investors quietly turn modest investments into massive income streams. They don't chase the flashiest yield today. They focus on growth tomorrow. Mistake number 4. Assuming dividends mean no innovation. This is a myth. People think if a company pays dividends, it must not be investing in new products, research, or expansion. But look at company capital to shareholders. Dividends don't stop innovation. They show that a company is generating more cash than it needs, which is the ultimate sign of financial strength. Here's another important point. Dividends provide psychological stability. Most investors think only about price. When prices fall, they panic. But dividend investors have a completely different mindset. Even when the market is in free fall, they're still receiving steady payments. That cash flow makes it easier to ride out volatility, and that's one of the biggest secrets to long-term success. In fact, studies show dividend payers. That matters, because avoiding panic selling is half the battle in investing. Now, let's look at history. Over the last century, dividends have contributed about 30 to 40% of the total return of the S&P 500. That means if you ignore dividends, you're throwing away nearly half of what the stock market has historically delivered. Think about that, half. You wouldn't play poker and fold half your winning hands. So why would you ignore dividends in your portfolio? And this leads to mistake number 5. Believing dividends are only for retirees. Sure, retirees love dividends because they provide income without selling shares. But younger investors can benefit even more. Why? Because reinvesting dividends accelerates compounding. When you're young, every dividend check you reinvest buys more shares. Those shares then generate more dividends, which buy even more shares, and so on. Over decades, that snowball turns small investments into life-changing wealth. Let me give you a simple example. Suppose you invest $10,000 in a dividend stock that yields 3% and grows its dividends 6% per year. If you reinvest those dividends, after 30 years, you don't just have $60,000 or $70,000. You have over $57,000 in dividends alone, plus massive capital appreciation on top. That's the power of compounding in action. So, what's the truth about dividend investing? It's not boring. It's not just for old people. And it's not a waste of time. Dividend stocks represent discipline, financial strength, and long-term wealth creation. They allow you to earn while you hold. They reward patience. And they protect you from the biggest enemy of investors, your own emotions. People are wrong about dividend stocks because they look only at the surface. They see the yield, or the stereotype, or the idea that dividends are old-fashioned. But beneath the surface, dividends are the glue holding long-term investing together. The reality is simple. Growth stocks might make headlines. Meme stocks might get clicks. But dividend stocks quietly build fortunes. And here's the irony. What people call boring is often exactly what makes you rich. So next time someone tells you dividends don't matter, remember this. Dividends are not just checks in the mail. They're proof of ownership, proof of discipline, and proof that wealth doesn't always come from chasing the next big thing. That's why people are wrong about dividend stocks.